Hello there. Welcome to the Week Ahead show, where we analyse all of the economic and corporate data that you should expect and indeed brace yourself for as we wrap up this relatively quiet week as investors gear up for earnings season, of course, and a plethora of global inflation data too. But it wasn't without its drama, was it? We had oil prices rising as much as 4% of fresh hopes over a proposed freeze in oil production. Copper prices endured the biggest weekly loss in 3 months because of concerns over a lack of global growth and plenty of supply in China as well, while the Japanese yen's rapid rise against the dollar mystifies the market. So without further ado, let's have a look and see what economic data we've got coming up on Monday, April the 11th. We've got Japan's machinery orders and China's inflation too. We are going to analyse China's inflation in just a minute. Tuesday, it's Australia's NAB business confidence, Germany inflation, UK inflation retail price index, US import and export prices. That's the Red Book data, that one. And then on Wednesday, we've got loads. We've got Australia's consumer confidence, China trade balance, France inflation, Eurozone industrial production, US retail sales. Again, that's another one we're going to analyse. And we've got Canada's interest rate decision and the EIA crude oil inventories too. Thursday's another busy one. Again, we start in Australia for the unemployment rate, Eurozone inflation, and the UK, the interest rate decision from the Bank of England. US inflation finishes off Thursday. Friday, again, we're in Australia for the beginning of the trading day with consumer inflation expectations. China GDP, Japan industrial production, Eurozone trade balance, US manufacturing index, and the US Michigan consumer confidence as well. So we've got Chris Beauchamp here, as always, to analyse and scrutinise and just pick out what we should put at the top of our calendar, what we should look out for. What do you think will be the main point to look out for next week?
Well, on the economic front, we're seeing the return of China data in quite a meaningful form, which is something that's been absent over the last few weeks. We've been wondering what exactly is happening in China. The general theory is that we've seen improvement in the economic outlook. We've seen the government stimulus beginning to bear fruit, and crucially that's been seen in commodity prices as well. We're hoping to see a slight improvement overall in the outlook for Chinese growth, not just in GDP terms, but also a slight rise in CPI as China continues to manage this transition from being a very high growth economy, remember those 10% growth rates of years past, down towards 6-7%. Crucially, though, they've managed to avoid any fears of a hard landing at the moment, i.e. economic growth below 6% a year, which for China would be very low indeed. And that was the big worry for markets, certainly in January and February, that maybe they were just losing control of this. If you look at the China 300, which is sort of the gauge, if you like, sort of the broader measure of what we're doing in terms of the Chinese economy and Chinese stocks, you can see how we have rallied off the lows of February, but not really in the same impressive way that you have had in markets in the US and in Europe, where it's been almost a one-way move over the last couple of months. That's not happened in China. I think they're waiting for this GDP data, they're waiting for the catalyst to push this one higher. And if we do get some decent numbers out of China, if the industrial element particularly looks strong, then you might start to see a bit more bullishness creep into Chinese stock markets. And
as you say, the days of double-digit growth are well and truly over, aren't they? Let's talk about UK then, the CPI data. It's a busy week for the UK as well, because we've got the Bank of England talking too.
Yeah, let's deal with the Bank of England first. Nothing really expected from them. The current vote is 9-0 to keep rates unchanged. That's expected to stay the same. The key will be in the commentary you get with the statement on how they view the strength or otherwise of the UK economy at the moment. And I think they'll probably say it's looking mixed, but we have seen improvement, but we still don't think the time is right to raise rates. So you might get a bit of downward pressure on the pound, but you can see from the chart you have seen it come off quite a bit the last sort of week or so, downward move. So that's definitely what's worrying us at the moment. And if it breaks through this sort of 140.50 level against the US dollar, just that middle line there, then you could see a swift move back down to those lows at the end of February, just above sort of 138. So you could see a bit of weakness in the pound. Conversely, if you get a bounce in the pound on the back of that CPI data, if you see CPI figures which are expected to rise slightly, and if they rise by more than expected, that should provide a bit more of a boost for the pound against the US dollar. So perhaps it could put it back onto an upward footing, up towards 144 in the short term, and maybe it continues to move higher from there. Of course, if the dollar continues to weaken as well, that will help sterling move higher too.
All right, sterling in focus. Also, have US shoppers, have they been splurging?
Yeah, US retail sales also expected to come through this week. So if we're watching something like the US dollar index, can it start to rally off the lows we've seen the last couple of weeks? Because Janet Yellen has been doing her best to talk down the US currency, or at least that's been the effect of what she's been saying. Essentially agreeing with the market that we won't see too many rate hikes this year in the US. So if it's been stabilising as we think it has the last 3, 4, 5 sessions, you might start to see a rise in the US dollar. That might make life difficult for things like the euro to keep moving higher, because we've had a very strong performance from that this week. But at the moment, people do expect the Fed not to get too carried away with rate hikes. So that bullish drive in the US dollar we've had over the past 18 months or so seems to have dissipated to some extent.
Okay, well, we want to talk about corporates as well, because it is earnings season. We've got some big names coming up next week. And as always, Alcoa starts it all off as well. We've also got big names coming up on Tuesday as well. It's ASOS, the online fashion retailer, Michael Page as well, and Intel. On Wednesday, look at that. You've got Tesco, Halfords, Atkins, you've got JP Morgan too, and at WH Smith. But Thursday is the busiest day. Look at that. Yeah, loads. Burberry, the fashion chain, Mothercare there, Unilever too, Hays. Lots of recruiters coming up next week, but we've got a lot of retailers as well. Debenhams, Poundland, and it's all about US banks, which we'll talk about too, and BlackRock. Finishing it all off then, it's Man Group, as I say, lots of recruiters. Citigroup, another US bank, and Renault America as well, the tobacco company. So, Chris, where do we start? It's going to be a really big corporate week, isn't it?
It is, and we'll come to US earnings season in a minute, which is going to be the big event of the next couple of weeks. But we'll start with Tesco, which is having full year earnings coming through this week. So supermarkets have had a better time of late. We've seen improvement in their market share, certainly for Tesco. Some of the sales figures have started to look better as well. And there's a sense that maybe the worst might be over for this sector. If you look at the share price performance from Tesco, if you'd bought Tesco at the beginning of the year and you closed it out now and you were a fund manager, you'd be very, very happy with your performance for the entirety of 2016. The share price up considerably from that £1.40 low we had right at the beginning of 2016. But the question is now, what about 19 times earnings? Is it fully valued, or is there more good news that can keep the share price pushing higher? Well, that will have to wait until the full year earnings this week. If the outlook is good, it's always really about the outlook, really, where full year earnings are concerned. If they're in line with expectations, then we worry about what the supermarket thinks will happen next. With Dave Lewis still trying to get the supermarket sort of recovering from the lows of last year, if it can start to take back market share, and if it thinks it's in for a good summer period, you might see the share price pushing back towards that 200 pence level we had in the course of March, and that would really kick the uptrend back into action. If it does sound rather cautious on the outlook for the year ahead, then you might start to see these gains start to wither back down towards 180 in the first instance and possibly lower.
Okay, but it's still Britain's biggest supermarket though, so it's still holding on to that title. Should we do the US banks then?
I think it makes sense.
No.
It's the key one, really. Alcoa kicks off earnings season as ever, but really it's almost a sort of a formality, really. The big thing is what happens with the US banks, and they've been suffering a lot over the past 3 or 4 months because we thought the Fed would start raising rates more actively than they have done, and that would help interest rate margins at banks to rise, boosting their profitability. Mm-hmm. That hasn't happened, and that's why the share price has been so depressed. And if we look at JP Morgan as an example of that, you can clearly see that yes, they've rallied off the February lows, but they haven't been able to push on. And I think if you get earnings season that is fairly negative, and if they don't beat the admittedly low expectations, then you'll start to see an unwind in the share price of these big banks. And if they start to fall, the broader market will likely go along with them, because US banks, after all, are a bet on the US economy. They're a bet on the global economy as well, but they are chiefly a bet on what the US economy does. And if they falter, and if their trading revenues start to weaken as well, which has been the case the last couple of quarters, you might start to see quite a big unwind in these share prices.
Mm-hmm. We've also got Bank of America and Citigroup as well to look out for in terms of US banks. But let's talk about Intel then, because we know that the profit revenue has stagnated in recent years, and that's because of demand for PCs has gone down.
Intel, of course, once the greatest PC supplier, now having to shift towards new products. The cloud, of course, is another one of those key innovations that they've been trying to push in terms of their product line. it's not been a bad few months for Intel shares. You can see again, it's all the same thing really, off the lows of February, and again you might have something of a rising trend from the low in August. And if you argue that actually you're seeing a sequence of higher lows rather and higher highs, then maybe we're starting to get that, and these results could start to energize the share price to push them higher, at least in the shorter term. But we want to see how these other businesses, how these cloud computing bits are going to work. If we look at maybe earnings season just more broadly, just to finish off as well, we're expecting a dismal performance from the energy sector, of course. Earnings supposed to fall off a cliff. Reuters analysts, or a survey of Reuters analysts, expecting a 99% drop in US earnings for the energy sector. Some better performance from the likes of healthcare, telecoms, and crucially consumer discretionary, so consumer spending like retailers, internet retailers. So they could do exactly as well in the UK. That's also starting to look better. But in the US, consumer spending is looking fairly robust. So that might be the good parts of an earnings season that otherwise might be quite dull.
Oh, we don't want dull, do we? All right, well, thank you very much. That is our week ahead, so it's going to be really busy, so buckle up. There's lots of big names coming up. Of course, it's US earnings season. We've got those US banks, we've got retailers, recruiters. It's going to be busy. See you next week.